SOFI is a company that has been in absolute pain over the last couple of years, and with rate cuts around the corner, things could finally be changing. Unless, of course, if we get a deep and prolonged recession in the US. So in my video that I'm going to link up here, I basically laid out the reasons why SOFI can potentially 3x from where it is today, but at the same time, asking you to be aware that management could be selling us a bunch of baloney. So what I'm going to do here today is to use the numbers that management have given to us with as little assumptions as possible to project out the business over the next couple of years, and perhaps get a glimpse into how Anthony Noto plans to get SOFI to the target price of $25, $35, and $45 so that he can get his bonuses. And so our job as investors is twofold. The first one being to determine whether or not we think the company can achieve its goals within the time frame it has given to us. And the second thing is to actually set out tangible markers of progress towards that goal so that we have something to hold on to along the journey. You see, to me, SOFI actually has a pretty sticky business model. Now, in the past, they were primarily a lender where about 90% of their revenue actually came from lending. Now, over the years, that actually decreased to 70%, and eventually now in 2024, we're seeing it just hover above 50%, right? So only 50% of their revenues come from lending. Now, a lot of their revenue growth was actually driven by their fastest growing business segment, which is their financial services platform. Now, this financial services platform is things like their SOFI app, their credit card, and things like that. So all these things are actually have fixed costs. However, it's very, very scalable. Now, on top of all of that, you also have to consider their tech platform. Now, their tech platform, right, is basically Galileo, Technisys, and they offer these services to other businesses or other financial institutions to build out their back-end financial infrastructure. And so to me, all of this is basically the reason why if they execute, SOFI has the potential to 3x from where they are today. However, we still do have to address the elephant in the room, which is that ultimately 50% of their revenue do come from lending, and when people look at their loans portfolio, they're actually a little bit concerned that a lot of these loans actually come from personal loans. Looking past the default rate, right, which actually management addressed in their Q2 2024 earnings, when I look at SOFI's loan portfolio, actually what gets me excited, right, is how they've managed to pivot their business from one loan to another. Now, you see in the past, SOFI was actually known as a student loan provider, right? They're in fact the largest student loan provider in the US. Then now basically people are worried because they think that, oh, SOFI is this, personal loans provider. However, I would argue that actually SOFI is neither of this. They're actually a bank, that provides three different types of loans, and depending on the macro environment, they're able to drive demand to either one of these three loans. So right, I don't just actually say this off the cuff. If you take a look at me in the past, right, 2018 when Anthony Noto took over, 55% of their loan portfolio consisted of student loans, 37% came from personal loans, and about 6% came from home loans, right? So basically that maintained the trend all the way to 2019. Now in 2020, pandemic happened, and then what happened? Rates started to fall. So at this point in time, you can actually see just within a year, they 3x their home loans revenue from over 700 million to $2.1 billion. Now, at this point in time, you can actually see the loan portfolio actually start to change. 50% student loans, 26% personal loans, which actually fell, and then a shoot up of about, like I said, 3 times, right, in home loans from about 700 million to 2.1 billion. About 22% of their loans were made out of home loans. Now, these numbers kind of persisted in terms of the home loans to 2021. However, we also know during 2021, the student loans were being paused and things like that, right? And the effect of that were actually seen in their portfolio. And to make up for the pausing of student loans, they actually moved into personal loans. And then even as the Federal Reserve continued to hike rates in 2022, lesser people were taking on housing loans. So you can see the percentage of housing loans drop, and to make up for that, they basically drive demand into personal loans. So to me, when I look at it, I don't see SOFI as a student loans company. I don't see them as a personal loans company. I feel like they are able to drive demand to any one of these loans basically at the snap of their finger, because I think people don't really focus on mortgage or home loans when it comes to SOFI because they have been in the news for student loans and for personal loans. But if you take a look at 2019 and 2020, I think it's quite impressive that within a year, at the snap of your finger, you basically 3x your loan originations for home loans. Their acquisition of Wyndham Capital last year really positioned them to expand their mortgage offering this year, especially as the Federal Reserve starts to cut rates. So I'm actually not too worried. I'm quite excited to see how they're going to adjust their loan book moving forward to match the macro environment. Now, if you listen to SOFI's management often enough, right, you actually realize that they have two very clear goals. The first one is to become a top 10 financial institution in the US. Second one is to become the AWS of fintech, right? So it's a bit like Amazon, right? Amazon built AWS for their own use and eventually licensing it out to others. And I think we are seeing the same thing with SOFI. They use Galileo and Technisys to build out their back end. They enjoy their own cost savings, and then after that, they license this product. Now, on top of that, I think these two goals that management has given to us are their long-term goals. but I think something more measurable in the short to mid term is their 2026 EPS target of 55 cents to 80 cents. Now, to put this into a bit of context, right, if you consider at the end of 2024, their expectation is about a 10 cents EPS. They're basically telling us that in 2 years, our earnings will grow by 5 to 8 times. So I think it's important for us to talk about a couple of things that if done well, SOFI can actually hit their target of growing their earnings by 5 to 8 times within the next 2 years. And at the same time, also assess the risk that can potentially keep the stock price down for longer than we expected. So let's dive in. So let's start with the most obvious. Now, to be a successful bank, you need people opening accounts with you, using your services, using your products like your credit cards and things like that. So that is the first thing I actually track, member growth. Now, why this is important, right? SOFI doesn't just target anyone. At the moment, they're actually targeting millennials and Gen Zs, not just any millennials and Gen Zs, people with average salary between $140,000 to $160,000 and above every single year, and a FICO score of above 740. So this basically means, they're targeting the mass affluent crowd with relatively high earning powers, right? So some people call this group of people Henry, high earners, not rich yet. So that's very important in understanding the thesis of SOFI and why I'm tracking certain numbers. Now, as SOFI grows, right, I don't expect them to only serve the mass affluent crowd, but to actually have a more mass market customer base. That is at least my thesis, and it's similar to, Tesla's plan: build the expensive car, use the profits from the expensive car to build a less expensive car, use that profit to then eventually build an affordable car for everyone. So as they serve the mass affluent crowd today, using the cash they generate, they build out their products, their services, their tech platform and things like that, which is basically what management has been updating us about. I believe that as they grow their customer base, these FICO scores and this average salary will eventually start to drop over time. The dropping of the FICO score, the dropping of the average salary are concessions I'm willing to make in exchange for strong customer growth. And my arbitrary threshold for now is as long as they're still serving customer bases above the national average in terms of FICO, in terms of average salary, then I'm not too worried, because you have to consider management's current track record, right? It's actually quite good. And so because of that, I actually feel safe with the way that they're operating. So we cannot be blind to the risk, but we also need to know where to look for the flashing red light. So if you take a look right now, right, the current US average salary is about $60,000 a year. So, with SOFI targeting people earning between 140 to 160K and above, they're actually quite safe there. So when it comes to FICO score, right, the US average FICO score is about 717. The average FICO score of a SOFI customer is 744. So you can actually see SOFI kind of, have quite a big buffer there in terms of the type of customers that they're serving. And if you look at the FICO score range, which means that a lot of their customers are in the very good and exceptional category. And so you see, when it comes to member growth, right, SOFI's management has projected out at about 30% year-over-year growth, aiming to eventually grow at a pace of 1 million members every single quarter. And so now the question is, how are they going to get to that number of member growth, and how is this member growth eventually going to translate into revenue for the company? Now, to answer the first question, I spoke about investing in companies with big TAM, and I believe in SOFI that's exactly what we have. It begins with understanding the consumer behavior and the move to digital banks. This is important because you see, digital banks are targeted generally at millennials and Gen Zs, and that is exactly the target audience that SOFI is looking at. So if you take a look at the reports here, right, you can actually see that digital banking is poised to grow at about 14% CAGR through to 2033, and AI is basically only going to accelerate this process. If you take a look at what this piece of report actually says over here, it says the rise of digital banking has coincided with the decline in presence of traditional banks, which have faced a loss of more than 2,500 branches across the country in 2023. And later on in the report, it also says while traditional banks offer access to branches, digital banks offering online and mobile bank services often provide attractive yields. So this means that, right, these digital banks, they generally have lower costs because of lower spend on maintaining traditional banking systems like branches and things like that. And because they don't have as many expenses, they also can pass on a lot of these cost savings back to the customer. So it's through things like offering better, saving account yields and things like that. And their products basically have better use compared to traditional banks, that they're slowly winning over the customers. You see, even in Singapore, right, we have banks like Trust Bank and Merrybank, both give higher rates just for putting your money in. You don't need to have any minimum balance and things like that. So potentially, right, this can help them gain market share as rates start to lower. You see, banks with higher costs will be forced to reduce rates at a faster pace than companies like SOFI, right? Additionally, the lower rate environment will also benefit SOFI's lending business as well. But that's not all, right? Because the second question we have to ask ourselves is how this member growth eventually translates into more revenue, increasing profits for the company. And this is where we take a look at another trend. Now, this is called the Great Wealth Transfer. Now, I've seen different figures, right, over different reports, and I believe a lot of them are just estimation. And basically, it puts the figures at anywhere between $40 to $80 trillion worth of wealth is going to be passed on to Gen X and millennials. Now, and all this money has to go somewhere. And if SOFI is your primary bank or even your second bank, I think that's likely where it's going to go. And that's how they eventually aim to become a top 10 financial institution. This is where I believe SOFI is perfectly positioned, to actually benefit from this trend. Now, after covering all the fundamentals and all the macro trends that actually affect the stock, right, actually one of the things that interests me is basically how financially manipulated this stock is. So I find find the stock price movement, for lack of a better word, a little bit artificial lah. So basically, I feel like, there's a lot of, not in a bad way, but financial manipulation going on in this stock. And there's some weird mumbo jumbo, keeping the stock down for no apparent reason. So there are a couple of reasons here that I want to go through. We're going to start with the most straightforward issue, and then we talk about the more complicated ones later on lah. So the first thing, right, is that SOFI is actually one of the most shorted stocks on the stock market, right? At one point, it was over 23% short. Today it's over, I think, 18 or 19% short. So for our context, a company like Tesla, who's also quite volatile, is only shorted at about 2%. So there's definitely artificial selling pressure here. Now, why are people shorting this company? It could be for a variety of the reasons. I think the most straightforward correlation to me is basically because SOFI is a small lender. This is a high rate environment, and lenders, they think that they will do badly in the short term lah. However, SOFI has proven that is not the case for them, and they're actually doing well even in a very challenging macro environment. So, and eventually, as the macro environment changes, SOFI continues to do well. These shorts cannot stay short forever. They have to cover their short position by buying back the shares, and so this will eventually drive the share price up. Okay. Second and third reason, both of them are kind of related. So let me try and explain it as simply as I can. If you have any questions, you can ask me down in the comments below. Otherwise, if you've got no questions, then you can just hit the like and subscribe button right now. Thank you very much, and back to the video. Now, simply put, the Qatar Investment Authority, QIA, basically sold their 20 million share position that created a lot of selling pressure. And when there's all this selling pressure without enough buyers, then the share price will fall, which is basically what we're seeing, right? But I think what is important to note, right, is that actually they were mostly holding preferred shares. Now, all these preferred shares were actually redeemed early on in the year, which is basically the third reason why the stock price is down, and I'll talk about that later on. So when these preferred shares were redeemed, all they were left with is, these 20 million shares that they had. And this Qatar Investment Authority, right, were basically on the board of SOFI. But in order for them to remain on the board, they have to keep at least 50% of their original investments. And so when these preferred shares were redeemed, right, their position become less than 50% of their original investment. And so rather than buy back the shares, I think they decided to just, totally liquidate the position and reposition the funds since they are no longer on the board. Now, disclaimer, okay, don't come at me, okay, I know this is not how preferred shares work, but I'm just breaking it down without all the financial jargon. So you imagine you gave me $10,000 to start my business, right? So now your $10,000 grew to $20,000, and I returned to you $16,000, which means you only have about $4,000 left invested. So if you want to remain as my board member, what you have to do is you have to give me another $6,000, right? Because 50% of your original investment, which is $20,000 now, is $10,000. But instead of doing that, you decide to reposition your portfolio since you already doubled your money, and so you sold off your remaining $4,000 position to someone else. That's basically all it is. That's basically all that happened. And this selling created artificial selling pressure that kept SOFI stock price down over the last couple of months. How is all this actually related to the third reason that I'm talking about? You see, this Qatar Investment Authority, right, their preferred shares being redeemed was part of SOFI's decision to redeem all their preferred shares earlier on in the year lah. So basically, they had this bunch of preferred shares where they were actually paying about 12.5% dividends on these shares, which will increase to a 15% dividend by May of 2024. So instead, what SOFI decided to do is they took out another loan at 1.25 interest, and this is a special type of loan where they will actually pay back in shares. So why this is bad, right, is because, well, dilution, right? The moment you actually pay back people in shares, you're actually diluting the existing shareholders. So in simple terms, dilution is basically this. Now, imagine your business is worth $10, right? Two of us own the same business. If we were to sell off the business, each of us will receive $5. Now, if two other people come into the business and the business is only worth $10, what happens? Each of us is now basically only entitled to $2.50 if we end up selling the business. And this is the problem of dilution. When a company dilutes its shareholders, it basically needs to make up for the dilution by growing faster. If at this point you think, I'm going to say that, SOFI will have strong growth, so the dilution is fine, you are wrong. I don't really buy into the let's dilute the heck out of shareholders because, one day we'll grow faster narrative. I think there are some exceptions to the rule, but that's for another video, right? But without getting too technical, SOFI actually structured the loan in such a way by including this thing called cap calls. I don't need to go into the details to explain what those are, but basically what it means is that while they diluted the shareholders, right, with more shares, they actually also grow their book value, means they actually grow the value of the company itself. So it was a net neutral move, which means that yes, I'm giving more shares, but my company also becomes more valuable at the same time. So when I divide the value of the company by the shares, it's actually, the same. So basically, going back to my example, maybe if the company is valued at $10, two of us were to share the company, if we were to sell the company off, each of us get $5, right? But by increasing the value of the company to $20, although I get another 2% in to share the value of the company, 20 divided by 4, each of us will still get $5. So it's basically a net neutral. This is the easiest, quickest way to understand what is happening. That's not actually what happened. This is just the, most layman terms so you can understand what was happening. And so to me, all these things are financial restructuring, financial engineering, a little bit of mumbo jumbo that affected the company in a year where they're also in transition. So it feels like every time you get some sort of good news, right, something happens outside of the company's control that keeps the stock price down. But, there's only so long that can happen. Of course, that is not to say that there are no other risks involved. I think there are two big risks that actually face SOFI, and they really need to address some of these risks. So firstly, one of the biggest risks I see is actually their tech platform. Now, if they fail to scale their tech platform, and why I say this is because in the last quarter, they actually showed that there's growth in the members of the tech platform, but in terms of revenue growth, it's only at 9%. So is it because they are slow in implementing and things like that? We are not too sure. But if they want to command a hybrid multiple, which means not just a bank, but people to see them as a bank and a tech company, then their implementation has to be faster. Because people will end up just valuing them as a fast-growing bank, which is not a bad thing, but neither is it groundbreaking. So for me, right, it's actually very important that SOFI's tech platform, Galileo and Technisys, really achieve scale like other SaaS company, and they actually achieve this hybrid multiple of a bank and a tech platform, without which I think it will really affect my exit strategy for SOFI. Because if they cannot scale their tech platform and they're just a fast-growing bank, then I'll probably consider exiting from this position earlier than expected. But however, that's not really something that I'm too concerned about in the near term. However, one of the more near-term concerns, right, is if the US economy really enters a bad recession. Now, I know SOFI actually forecasted for a recession as they projected out their business for 2024. So we will see how they project out their business for 2025. But because, no matter what, 50% of your revenue still comes from loan, no matter what, you're still going to be affected if the economy goes into a recession. However, I do think Anthony Noto is a smart guy. He's experienced in the market, and I trust that he can navigate through a recession. You see, in the past, right, when they stop student loans, SOFI still grow. They keep increasing interest rates, SOFI still grow. So I think ultimately, what this could mean is that maybe the share price can stay lower for longer. However, in terms of the business-wise, I'm not too worried because the management team has proven themselves over time. Now it comes to the part of the video, right, where we're actually going to take a look at what management has been telling us over the last couple of quarters, using the numbers that management has given to us, and see whether or not, by projecting out SOFI's business in the next couple of years, whether or not it is possible for them to actually hit their targets of $25, $35, and $45. So we start from the top of funnel, member growth. Now, management has told us, like I said before, to expect about 30% member growth going forward. In 2024, they actually expect 2.3 million new members. However, if you take out the 622,000 members added in the first quarter and 643,000 added in the last quarter, basically what you're left with is you're expecting about 517,000 new member growth in the next 2 quarters. To me, that is kind of crazy because the last time they experienced such slow member growth was over a year ago in Q4 of 2022. So this is the only part where I'm going to add in my own assumptions for the projections, and I'm basically expecting them to at least maintain what they were doing in Q4 2024, which means that in Q3 of this year and Q4 of this year, they're going to grow members at only 630,000 members every single quarter. Then when it comes to product growth, right, because you get the members in, the members actually use your products, and that's how they actually generate money. When we talk about product growth, actually, if you listen to what Anthony Noto said in June of 2023, he said that, we expect this number to hover around the 1.5 product per member usage for the next 12 to 18 months. Now, this is because they're focusing on member growth. So, as new members come in, they will not, immediately come in, use 3, 4, 5 products and things like that, right? So people will eventually grow into the platform. So as they're onboarding new members, they expect this, products per member number to stay around 1.5 for the foreseeable future. However, this timeline actually expires on the end of 2024, so we'll have to see what he says about it by then. But from my perspective, I think their revenue has been directly correlated with member growth, and as they grow members, their revenue grow. But I think let's not forget that, one member can ideally use more than one product. So for me, I actually like to correlate product growth with revenue rather than member growth with revenue. So of course, that's not to say this is the only way to do it. Some people that want to do it through member growth is also possible, but that's how I'm doing my calculations, because the product itself is what generates the revenue. In terms of projections for this year, I basically look at what they have done in the second quarter of this year, which is about 1.45 products per member, and I'm basically keeping it constant all the way through the end of the year. I think, right, we have to understand that actually growing members by itself, having members use different products by itself is not enough. You see, because you have to, put out bait, something to lure the members in, right? And then when the members come in, then they start spending money. So imagine a business, that pays $500 for marketing. You do your marketing, you get 2 customers, which means each of these customer costs you $250 to acquire. And this is what we call customer acquisition cost, or CAC, CAC, right? It's something I like to pay attention to, especially in small growing businesses. Now, this means that, if your marketing efficiency remains the same, no change, you want to serve 20 customers at a CAC of $250, that means you have to pay $5,000 in marketing. Now, this is a very unsustainable business model, which means that if I pay money, put money into marketing, then more customers come in. If I decrease my marketing spend, less customer comes in. So this is not a sustainable business model. We want to see a business model where marketing actually can stay constant or actually decrease over time with more and more customers coming in. So if we take a look at SOFI's CAC, right, that has actually gone down from about $400 per customer to now about $280 per customer. Now, the only outlier is Q3 of last year, 2023. That's when, Taylor Swift had her concert at their stadium and things like that during her Eras tour. So apart from that, I would say that their customer acquisition cost now is about $280 per customer. And in comparison to legacy banks like Bank of America, these banks have a customer acquisition cost of $600 and more. So this is definitely encouraging. Now, for the rest of the 2024 projections, we're going to keep it more or less the same. Full year revenue, 2.42 to 2.46 billion. Lending basically is going to be 95% of 2023 revenue. Financial services growing at 80% or more. Their tech platform growing at mid to high teens, right? Adjusted EBITDA for the whole year, 605 to 615 million. GAAP net income of 175 to 185 million. So around there, right? Which means an EPS of about 9 to 10 cents. And why is this important, right? And because management has told us this many times, in 2026, they aim to reach an EPS of about 55 to 80 cents without any new businesses, which means basically whatever they have now, they just have to keep operating it at a faster and better rate, which is pretty insane if you think about it. They have actually 10 cents EPS this year. They are saying that basically in 2 years, we'll grow our EPS by 5 to 8 times. And then not only that, they actually tell us that after this, they will maintain a 20% CAGR all the way to the end of the decade. Now, I don't have time in this one video to actually project all the way up to the end of the decade. That will have to be in a separate video. If you're interested to look at my projections past 2026, do let me know down below and I'll do that in a separate video. So how do we get to the EPS of 2026? Now, before we dive in, I want to preface by saying this is my own estimation, my own calculation, my own projection. They can be wrong. You definitely should not take my word for it. Okay, so let's go. Now, from the way I see it, right, there are a couple of ways to value SOFI. I can definitely go product by product, map out the growth of each one, something like a DCF, and I think that works for a lot of mature companies, businesses that are already fairly built out. However, I think for smaller businesses, when you do that, you actually make a lot of arbitrary assumptions that you don't actually know whether or not are true. So you see, someone can just take the DCF, assume 10% growth, you get one valuation. Another person takes the same DCF or same calculation, puts in 20% growth, and they get another valuation. And it works, in a mature company because the game is about optimizing your business, not growing your business. So in SOFI's case, what we want to do is not just look at, putting in numbers and then finding the final answer. That's not the valuation of the company. We actually have to understand, right, where does these assumptions come from? So when I say 20% growth, how come I say that? It's because revenue is generated by member growth and product growth. So sometimes I think the danger of a DCF and things like that is that the whole valuation process become a game of maths more than, investing or business. So likewise, I say for SOFI, management has told us, this is 2024 results, this is 2026 expected results. It's not just so simple, join the dotted lines, because there's so many ways for SOFI to get from 10 cents to a 55, 80 cents EPS. Now, if SOFI actually goes from 10 cents this year to $1 next year and then down to 55 cents next year, then it actually signals that there might be something wrong with the company, and there might be a reason why you might want to sell out of the company at that point in time. However, if it goes from 10 cent to 11 cent to 55 cent, then I'm also skeptical because, how come there's a sudden big jump in their EPS and things like that? So the assumptions that you make in your calculations do matter. All right, so let's put management's word to the test. Let me show you how this works. We start top of funnel for SOFI, which is member growth. We project member growth based on their assumption of 30%, right? So that's what you're seeing over here in the first line, member growth for Q1 to Q4 of 2025. Basically, using SOFI's guidance of 30% member growth. Now, basically, when you take a look at the second line, you can see these two components here. One says switch, one says sentiment. So basically this switch, I can change the number from 1, 2, and 3. And as you can see, as I change the number over there, the sentiment changes from bear, base, and bull. So basically I have 3 different assumptions: my bear case, base case, and bull case. Now, what this switch actually does is to input some of these assumptions into the calculations. Let's take a look over here. Right at the bottom, 2025 switch. I'm going to highlight it over here for you. Now, the bear case basically assumes a recession, which means that, we only see 1.3 products per member, a decreasing revenue per product of $43, and a net income margin of 7%, which is basically the net income margin that we're getting at Q2 of 2024. I assume the net income margin doesn't expand at all over the next few quarters, right? The base case assumes that, products per member stays constant as to what it is today, 1.45 products per member. However, revenue per product still decreases to $45 per product because more members are coming on. And then the net income margin basically rises just slightly to about 10%. In the bull case, products per member goes up, 1.5. Revenue per product stays consistent as to what we have in 2024, about $47, and the net income margin increases to 13%. So basically, as I change this switch over here between toggling between the numbers 1, 2, and 3, each of these change in sentiment will affect the total revenue, the total net income, right? So the one thing that is consistent over here is that the shares outstanding, I assume, there's a 5% increase year over year from 2024 to 25, and then from 25 to 26, the shares outstanding will just increase by 5%. So that will affect the EPS eventually. So in 2026, if we take a look at the assumptions, the bear case for 2026, right, assumes that the products per member is still lower than what it is this year at 1.4 times. Revenue per product is still lower, 45, and net income margin is only at about 10%. So that's at 2026. In the base case, basically assumes that products per member to be about 1.5. Revenue per product is basically about 47.50, which is even closer to today's numbers, and basically a 15% net income margin. And then products per member in the bull case, which is the best scenario, 1.55 times. Revenue per product also increases to $50, and then net income, basically SOFI actually hits their long-term guidance of about 20%. Now this net income margin, right, I didn't just pluck the numbers out from the air, just want to give you some context into where I get all these numbers from. See, these net income margin numbers, right, basically I'm comparing it with other companies in the sector. So Nubank, 31% net income margin. Robinhood, around 12%. All the bigger banks, JP Morgan, 30%. Bank of America, 26%, right? US Bancorp, also around 21%. So all these banks are within SOFI's target when they say they want to become a top 10 financial institution. So, if the margins are between, 12 to 30%, I think it's safe to assume SOFI will end up somewhere around there as well. Basically, let's take a look at the different scenarios, right? In the bear case, what this actually tells us is that, if US actually enters into a very bad recession, everything does poorly for SOFI. In 2025, we'll get an EPS of about 17 cents, and moving forward, extrapolating it into 2026, that will give us an EPS of about 34 cents. And just a quick note here, analyst projections, right, are actually not too far from here. All I have to do is to bump 2026 net income margin up slightly to about 12%, and you get an EPS of 41 cents, which is close to analyst estimates of 44 cents. So you can actually see, right, how bearish people are about SOFI going forward. And so that is where we actually find opportunities in the stock market. Now, in the base case, in 2025, you end up with an EPS of 28 cents, and in 2026, basically using the base case, you end up with EPS of 57 cents, slightly above SOFI's low-end estimate. In the bull case, definitely everything turns out well, right? In 2025, they end up with an EPS of 39 cents, and in 2026, they end up with an EPS of 83 cents, slightly above SOFI's high estimate, which means in my bear case, their EPS will actually grow from 10 cents to 17 cents to 34 cents. In the base case, it will grow from 10 cents to 28 cents to 57 cents, and in the bull case, it will go from 10 cents to 39 cents to 83 cents. And so when you look at these numbers, right, actually what you realize is I did not do any projections when it comes to revenue growth. I did not do any projections when it comes to growth of net income and things like that. All I'm doing is using management's numbers, plugging it into the member growth, and then understanding how members actually generate revenue for the company. And from there, we end up getting these numbers that are actually very close to what management is guiding for. So basically, this actually confirms to me that, how management actually does the calculation is probably pretty similar. That actually means that I can see the pathway from management getting from where we are today to 2026, and it's not too far-fetched. Now, when you get all these numbers, right, the EPS and everything, what exactly are you supposed to do with all these numbers? Now, unfortunately for me, right, when I actually look back at my transaction history, I totally forgot about this. But back when SOFI was about $4.50 per share, of course, I dollar cost averaged down. But one of the things that happened was that I was trying out certain option strategy. I totally forgot that I left some of my strategies open, and I got assigned a couple hundred of SOFI shares, I think about 500 shares at $15 per share when they were trading at about $4.50. And so because of that, I have a higher than expected cost basis. Now, my cost basis is close to $9. When I look at the comments, I see most of you are doing way better than me, having cost basis of around $7. Now, for today's calculation, I'm going to use my own cost basis, because if my $9 cost basis, right, can give a good returns, that means all of your cost basis can give you even better returns. Okay, so let's dive deeper into the numbers. Now, let me show you how I think about this and why, despite my high cost basis, I'm not in a hurry to sell. To do that, let's consider, similar companies in the sector, with Nubank having a PE ratio of 46, Hood PE ratio 60, Square PE ratio 65, and Lending Club with a PE ratio of about 30. Now, if you average this, you get an average PE ratio of about 50 times for fast-growing fintech, or in Lending Club's case, not so fast-growing fintech, with maybe subpar execution. Now, if you take a look at this table, how this works is that the first row, we have the PE ratio that we apply to the bear, base, and bull case EPS. Now, the second row basically shows us the share price, and in the last row, we actually get to see our expected rate of return over the next about 2.5 years, right? So in the bear case, even with my cost basis of $8.90 at 20 times PE, I will be down about $2 per share. Even at 25 times PE, I'm still losing money, about 50 cents per share. But for many of you, when I look at the comments, I see all your cost basis in the sevens. I'm really, really jealous. Then all of you will be doing fine in the sense that at least you are profitable. I don't think that's why you are investing in SOFI, for it to go from 750 to 850 in 2 years, but at least you are profitable. Now, if SOFI is still stuck in this price range by then, I think some people may start to reconsider this position purely because of opportunity cost, not because the company actually performed badly or anything. And I think that's fair, but I think it's always important that whenever you enter any investment, right, you actually understand the downside risk and are comfortable with it before making the investment lah. So for me, what I actually look at is I actually look at the base case, and at 20 times PE, we actually get a CAGR of 10%. Now, that's nothing fantastic, but at least you're matching the market returns, right? But at 25 and 30 times PE ratio, with the base case, we get a CAGR of about 21 to 30%. So that's pretty good, actually. I don't think anybody actually invests in SOFI, right, thinking that by the end of 2026, this is only going to be $14, $15. But I'm just saying, in the worst case, if that happens, you still get a pretty decent CAGR overall, right? Now, this is where it really gets juicy. When you use the sector average PE ratio of 50 and apply it to the base case, we actually see that the share price goes to about $28 per share, which is actually the first level of Noto's PSU, which means he gets to redeem his first 1/3 of all his shares. Now, what makes it even more exciting is if you flip the switch to bullish and you look at the sector average PE ratio, right, you get a share price of close to $42, which is very, very close to reaching the highest tier of Noto's PSU. Now, if you ask me, hand on my heart, I don't think they're going to get there by 2026. If I'm wrong, I'll gladly eat my own words. But I think, getting to the $40 range might be more of a 27, 28 kind of target. I'm actually only expecting him to hit the first levels of his PSU. I think the assumption that because there are 3 levels means he will hit all 3 levels. It's a little bit far off the mark. I think chances are he's likely going to try and hit 1 level of PSU. I mean, even hitting 1 level of his PSU, he'll be quite handsomely rewarded lah. So, but what makes me comfortable after doing all these calculations is not in seeing all these price targets and things like that. What makes me comfortable is that actually I know for a fact that when I use management's numbers with very little of my own assumptions, we are able to get EPS very close to what management has told us. All we are waiting for right now is for the market to realize it and to price SOFI appropriately according to the other fintechs. Because in the short term, the stock market is a voting machine. In the long term, people say it's a weighing machine. For me, why I actually enjoy using this method of analysis, right, is because we didn't actually use our own assumptions on revenue growth and profitability. All we actually boil everything down to is one trackable piece of data, which is member growth. And the whole investment thesis is this: if SOFI's business continue as per usual, they operate the way it does today, they don't need to do anything new at all, and all they have to do is grow members at a 30% rate. With a customer acquisition cost of below $300, they will be able to reach that 2026 earnings per share. So to me, the risk to reward is pretty attractive. I think bar a major recession, SOFI will be poised to do well. Now, if you like what I've done for SOFI, I've recently initiated a new position in a second company, and I do a deep dive on it over here, and I'll see you in the next one.